you guys enjoy. Julia's amazing. And this is probably some of the most valuable information you will get for making viable, secure folks.
Thank you, Amy Rose. Okay, so Becky has a question. I intend to operate like a teaching farm for children, but have not gotten started quite yet. I was recently contacted by a preschool that wants me to set up a teaching garden at their school. Do I consider this as part of my farm in terms of bookkeeping? Absolutely. You know, we'll talk about this later on, but as you analyze your costs, certainly you want to analyze your cost of production relative to production revenue, but you want to know what you're generating in revenue from other sources as well. That's all sort of part of the equation of figuring out what it's going to take to work. So we have different types of record keeping. We have financial record keeping and production record keeping. And if anybody is using 10, by the way, I'd be grateful to set up a call to learn more about 10, but that's a side conversation. So how we track matters. So what are we tracking in terms of financial record keeping? We want to know the date. When did we spend it? We obviously want to know the dollar value, and we want to know the purpose. What did we spend the cash on? It's not just that like, oh, cash left for the business, but was it production costs? Was it overhead? Was it payroll? There are different types of expenses, and how we manage them are going to be different. So if we categorize our expenses for their purpose, then we have a better understanding of what we need to do to manage it. So that's what we're tracking. And how we're tracking, I know a lot of you are using QuickBooks already, and many of you are using Excel. Certainly a paper ledger is fantastic. If that's what you got, I would love to see a paper ledger rather than nothing at all. But keep in mind that all systems take time. And I know that sometimes folks are intimidated by QuickBooks. QuickBooks, I'll be honest, the learning curve is steep. Once you get the hang of it, it's pretty straightforward. But you sort of take the effort into the data entry with QuickBooks, and then when you want to run a report or do some analysis, it's just the click of a few buttons. Excel is somewhere in the middle in terms of how much time it takes, both in terms of data entry and in terms of analysis. Paper ledger is certainly going to be the easiest in terms of data entry, but then when you want to do any sort of analysis, it's going to take a lot of time. So, it's a balance, and, consider your technical capacity, your financial capacity. If you can do QuickBooks, that's fantastic, but like I said, I'd rather see you do something rather than nothing. So Ashley is asking, how detailed should I get in terms of tracking? And, that's a great question in terms of the detail. You can track so much detail, like, was it black plastic or mulch? Was it this, these seeds or those seeds? And if you're tracking so much that you become like buried in a sea of numbers, that it's hard to do any sort of analysis. So, I tend to ask the question, like, is knowing that extra detail really going to help you understand your business? Certainly, it helps to track startup costs versus ongoing costs, because as you budget in the future, you're going to want to know what was part of startup and what was part of ongoing operations. I put this sort of slide break for questions, but I'm so delighted that people are not shy about asking questions. So certainly if folks have questions right now, I'm delighted to address one or two. Otherwise, keep asking them as we go along, and we'll keep going. Does that work for everybody? Good. Okay. Cool. So I tried to sort of put in some animation, I missed it, but these aren't the rules of bookkeeping, but these are some big rules of bookkeeping and things to keep in mind as you're setting up your system for the first time, as many of you are, or if you're refining your system, if you already do have a system going on. So rule number one of bookkeeping is, garbage in, garbage out. And as farmers, I know you know what that means. that, if you have crappy soil, you're going to have crappy tomatoes. And if you have crappy feed, you're going to have crappy tasting chickens. And if you have quality feed and you have quality soil, then you're going to have quality products coming out of the land. And the same is true with bookkeeping. If you have crappy data, if you're just sort of shoving numbers into an Excel spreadsheet or into QuickBooks and not really paying attention, then you're going to get garbage reports. You're not going to get anything meaningful. So, we want to consider, getting good data in so that we can get good outputs. And, the inputs are the sales data, your expenses, your loan payments, or, if you're receiving a loan or paying back a loan. And the output is going to be your financial statements. And QuickBooks is sort of this funnel that accepts all this data for you, that input, and then it spits out all of these reports. And these are the financial reports that you'll get out of QuickBooks, but there's also more detailed reports like your accounts receivable, who still owes you money, or sales by different products or items. So lots of reports that can come out of your QuickBooks. Dewey is asking, I want to be able to look at expenses and clearly see where the money is going versus sales. You tried setting up QuickBooks by enterprise, but there's a lot going into general supply. I know that I may have to change my chart of accounts or classes as I move forward. Yeah, so absolutely. This is the important part of tracking your expenses, that you want to group things like with like. And we'll talk a little bit about this more in a few slides. We'll talk about how to set up your chart of accounts, but you want to think about how you group things so that you can see things together. A good bookkeeping system is going to manage the input and provide the output. It doesn't have to be QuickBooks. Certainly we talk a lot about QuickBooks, but you can set up a good Excel spreadsheet. And if you're consistent in how you enter things in Excel, you can easily get the output from there as well. Rule number 2 of bookkeeping is that you're the boss. And, especially those of you who are getting started in QuickBooks, QuickBooks tries to be so helpful. It's going to suggest a chart of accounts to you that, you're going to tell them that you're a farmer, and they're going to say, oh, you're a farmer. These are the accounts that you should have in your QuickBooks. And, you don't have agricultural program payments. You don't have, or I shouldn't say you don't, but many of you aren't going to be selling to co-ops or cooperatives, or, so the way you get your money in and out isn't going to be the way QuickBooks thinks of an agricultural farm. So you want to set up your bookkeeping system in a way that makes sense for you and is going to give you the information that you need about your financials. And, which leads to rule number 3, that if you set up things in QuickBooks in a way that makes sense to you, it's easier for you to be consistent. If they have a category for supplies, it's like, oh, is that this supplies or that supplies? And, it's like, that doesn't make sense to me. But if you create your chart of accounts in a way that makes sense to you, then you can be consistent. So being consistent is 2 things. One, you want to be consistent in how you enter things in, that, seeds are always going to be entered as seeds into your system. It's not that some days it's seeds, some days it's farm supplies. It's always seeds. You also want to be consistent in how often you do your QuickBooks or your bookkeeping. You want to be regularly entering things into your system, because if you're consistently entering things in, then you can be consistent in how you enter things in. So it's going to ensure that you have quality data. And also, if you're consistently entering things into QuickBooks, you can make more rapid fire decisions. If you're only entering your data, once a month, mid-month, you may be, contemplating a big purchase and you don't know what your how much cash you have in the bank. And if you don't enter in your data regularly, you don't know how much cash you have. You don't know how to make a rapid fire decision if you don't know your numbers. Rule number 4 is to focus on managerial decisions. And I saw this little cartoon. I thought this was funny. a patient, a person has seen their psychiatrist or psychologist, and they say to the therapist, you say I should own my feelings, but my accountant says it would be smarter to lease them. And I think that just speaks to the tension that we have in bookkeeping in terms of managerial decisions, that your bookkeeper is going to say, oh, you really need to, or your accountant is going to tell you, you really need to keep your books this way because it's going to be so much easier to file your taxes. But if you keep them just, with the Schedule F in mind, which is the tax return that a lot of farmers use, then you're going to miss a lot of details. So don't be, bullied by your accountant to set up your book solely for the purposes of filing your taxes. You want to think about what's going to help you make decisions about your business. And if the tax accountant is worth their salt, they're going to be able to take your books and figure out how to make the adjustments they need to file your taxes for you. And finally, accountanese is a different language. And I think sometimes we sort of forget, it sounds like English, but it's not. And even though I do this for a living, I'll be honest with you, I've been talking to so many tax accountants lately, and I swear to God, I have no idea what they're talking about. I mean, like I said, I recognize the words as English, but they've been strung together in a way that I just don't understand. So we need to, learn a new language and, kind of divorce ourselves from English, and think about, revenue and income. And income is one of the words that is like most misused because, revenue is sort of like top line sales and net income is bottom line profit. And people will just say income. And it's like, do you mean top line revenue or do you mean bottom line profits? And is it gross income or is it net income or is it operating income? And people sort of, toss that word around, or margin or profit. And, so, as we go through our 4 weeks together, I'll be very deliberate in how I use words, but I might say, top line revenue to make sure that we all know that we're talking about what you bring in and not just, bottom line profit, what is left at the end of the day. Debits and credits is another one. In English, we think of debits as decreases and credits as increases. And in accountanese, debits is the left column and credits is the right column. So, how we think in English and how we think in accountanese is just not always the same. Dewey says, we also checked with a CPA who specializes in ag for thoughts and had us change a few items and clarified others. This helps him keep us on the same sheet. Yes. So, there are some settings in the desktop version of QuickBooks that can help you align to your chart of accounts with your Schedule F. So there are different tricks in there. And Jenny asked, does QuickBooks have a 2-category or subcategory ability? For example, I have market packaging in both supplies and market cost versus production or something else. Yes, so QuickBooks does have parent categories, and I call them parent and children, or accounts and sub-accounts. So there is, ways to nest the different categories. So I think a lot of people think, just about the income statement, and there are things that go on in your business that don't necessarily impact your income statement. So I wanted to bring in a framework of how to think about data entry, and I want to think about it in terms of the balance sheet equation. So who here has heard of the balance sheet? Anybody? All right, we got a few people who've heard of the balance sheet. Who here knows what the hell the balance sheet does? All right, well, I appreciate your honesty. Thank you. So the balance sheet equation is the balance sheet, and the balance sheet basically says assets equal liabilities plus owner's equity. So the assets are the things that you have, whether it's cash, inventory, breeding stock, infrastructure, equipment, things like that. What do you have that brings value to your business. And how did you get it? Did you borrow money or did you earn money? So if you borrowed money, you may have borrowed money from your vendors. You go to the regular hardware store, they say, don't pay us for 30 days. And they basically gave you a loan, a short-term loan. You may have a CSA, you get a line of credit from your customers. You may have credit cards or bank loans. And then you may have earned it. So if you have profits in your business, you have net income, that's why you have cash in the bank, because you earned it. So you have that equity. You may have invested your own money in the business. You may have, from before you started farming, you may have some savings that you may have invested to purchase equipment or products or whatnot. So that's your equity. And your balance sheet lists out your assets, your liabilities, and your equity. And it also is a formula of assets equal liability plus owner's equity. And Barbara asks, is it a snapshot in time? It is a snapshot in time. So you look at your balance sheet and it's like, what do I have at this moment? Whereas your income statement is, a period of time, like what happened in my business over a month or over a year. The balance sheet is where am I at this moment? And the thing to keep in mind about the balance sheet equation is that every single transaction that goes on in our business impacts the balance sheet. So if you're trying to sort of figure out what's going on with something, we can think about it in terms of the balance sheet. If we make a sale, we've got net income, our equity goes up and our cash goes up because we have cash in the bank. If we take out a loan, we're going to have an increase in our liabilities because we now have a loan and we have cash in the bank. Our assets go up. So there's two sides to every transaction, and they all impact the balance sheet. And I think it's kind of magical how it all sort of links everything together. So, here's the balance sheet equation: assets equal liabilities plus owner's equity. So things like cash are an asset, your tractor is an asset, your net income, your profits are the equity that you have in the business. Things like a loan are a liability. So when you open your business, when you start your farm business, you don't have anything. And then you you take out a loan and you have, $10,000 loan and you have a $10,000 balance in your checking account. So we've got two sides to the equation and the balance sheet is balanced and equal. If you buy a tractor, you're trading in one asset for another asset. You're taking your cash out of the bank and you're now buying a tractor. If you purchase seeds and supplies, you're taking, $2,000 out of the bank and the equity in your business is decreasing by $2,000 because you don't have it anymore. If you sell produce, you bought those seeds, now you sell some produce, you now have cash in the bank because you made $8,000 and you've now increased your equity by $8,000. And if you depreciate your tractor, the tractor has now decreased in value by $1,000 and you have a $1,000 expense. And at the end of the year, you have $11,000 in cash because you had the increase from the loan, the decrease from the purchases, the increase from the sales. You end with $11,000. You've got a tractor that's worth $4,000. You've got a balance of $10,000 and you've increased your retained earnings by $5,000. You have $5,000 equity in the business. This is your ending balance. This is a snapshot in time of what you have. And everything that's going down this this right side. Wow, haven't confused my left and right in a while. Everything that's going down the right side is your income statement. This right here, that ending balance, that's your balance sheet. And everything that's going down the left side is your statement of cash flows. And I think what's so interesting about, this, it's called transactional analysis. And if you remember from like 5th grade, I don't know if they still do this, but, remember in 5th grade, you had to dissect sentences to sort of, the nouns and the verbs. So I'm sort of like looking at trying to guess everybody's age and if it was happening 100 years ago when I was in high school, or if it's still happening now. Ebony says it's still happening now. You look younger than me. I'm sorry. I can't see for sure, but you do. But we're basically we're dissecting sentences like we did in 5th grade. We're dissecting these transactions. And what we can see about this is that not all transactions impact our income statement. Not all transactions impact our cash flow. All transactions impact our balance sheet, and they all link together. So I think it's kind of powerful to see that they don't sort of operate in isolation, they operate in concert. Any questions about the balance sheet equation? I'm going to kind of come back to it a little bit. And I think the key takeaway from this is net income does not equal cash flow. You may have cash in the bank, but it doesn't mean you have profits. And you may have profits, but it doesn't mean you have cash in the bank. And I think the key example is debt service. You could have a wildly profitable business, but if you're paying back loans, you're not having cash in the bank. And if you're taking out a lot of loans, you could have a ton of cash in the bank, or if you're getting grants, you could have a ton of cash in the bank, but it doesn't mean that you have a profitable business. So the two are not the same. QuickBooks is sort of like, behind the curtains of QuickBooks, all of this is going on. So you don't see it in QuickBooks. You don't see it in, if you're using FreshBooks or Xero. This is happening but behind the scenes of QuickBooks. And sometimes if you're trying to figure out like, how the hell does this get into QuickBooks, it can help to sort of think about this framework. What are the two sides? And, you can see this in QuickBooks. If you're writing a check to pay off, onto your credit card, or, you have a decrease in your cash, which is number one, side one. And then you have the expense here where I'm spending money on advertising and promotion, and that's the second side. So we have a decrease in cash on one side, we have a decrease in equity on the other side. And you can't see this because QuickBooks has this beautiful little interface that hides it, but this is what's going on behind the curtain. So keeping this in mind, your numbers tell a story. They're not just like all these numbers on a page. It's like how we organize them, how we shape them, tell a story. And you could tell one story, you're spinning your wheels, or another story is you're building equity. And with the exact same transactions, you can tell two very different stories. And let me give you an example. So let's say you purchase a greenhouse. So your first year in business, you have 100,000 in revenue, you purchase a greenhouse, and you have all your other expenses are $60,000. If you categorize the greenhouse as an expense, then you have a net profit of $25,000. You had revenue minus expense, net profit $25,000, and you have no assets. If you categorize that greenhouse as an asset, then your net profit is 40,000, 100,000 minus 40,000, and you have you have assets of $15,000. So which story looks more favorable to you all? Anybody want to jump in? And
it depends on what your goal is, what you're trying to achieve. If you ever want to go get a loan, you want to have assets because you need something for the bank to use as collateral. Mm-hmm. But if you're trying not to pay taxes, then you want the lower net profit. And a lot of farmers don't think about having assets. They want less expense, so they're paying less tax, or more expense, so they're paying less tax.
Yeah. So you bring up a really good point that, who are you telling the story to? Are you telling it to yourself, or are you telling it to the bank, or are you telling it to the IRS? And that goes back to the earlier point is like, bookkeeping for taxes is different than bookkeeping to make managerial decisions. And I can't remember who made this comment about the dairy farmer who was still, felt like they were just sort of spinning their wheels. How are they categorizing all their purchases? I'm working with a farmer right now, and every single thing that he purchased, he recorded as an expense, and it looks like the business has no profits. But in fact, he's got like 4 greenhouses, 2 barns, chicken housing, intern housing, and all this infrastructure on the farm. But the way he did his bookkeeping system, he's got nothing. He's got no assets on the books, and he's got no profits. So, it can also be really demoralizing. Yeah, this is great, you're not paying taxes, but it's also kind of demoralizing that you don't have profits and you don't have assets. So the same transactions can tell wildly different stories, and it depends on what story you're trying to tell and who you're trying to tell it to. Any questions about that? Or how are folks doing? Are you following along, out to lunch? I guess I shouldn't say out to lunch. Nobody's going to feel comfortable. Oh yeah, I'm totally out to lunch, Julia. I don't get this. But certainly feel free to ask questions. So how does this look on the balance sheet equation? So if you enter it in as an asset, you have your 100,000 in sales, you've got your expenses, which decrease your cash and decrease your retained earnings, your equity. If you purchase the greenhouse, then you still have the decrease in cash. Your ending balance is 25,000, but now you've traded in the cash for an asset. So, you've got your income statement with your $40,000 profit, and you've got your balance sheet and your statement of cash flow. If you record it as an expense, oh shoot, did miss the columns. Then you have, your 60,000 in expenses. It's the same. You still have the same cash flow. You still have the 25,000 in cash, but now we've recorded it as an expense instead of as an asset. So we're showing, our income statement, our balance sheet, and our statement of cash flow. So, and apologies, my animation isn't very good today. So we can see it's like the cash balance is the same. We still have 25,000 in the bank, but do we show profits or do we not show profits? And it's, the different story. So I think this was Dewey. A couple of people asked about, categorizing. I think Dewey and somebody else, I don't recall. So, we talked about being consistent and creating a system that's going to help you answer the questions that you have. And this comes from, how do you define your categories? So I like to think about, the income statement. How do we organize it to extract meaning? What is going to be the most meaningful categorization? And so if we sort of think about, what each section is, what goes where, we can sort of decide how we want to put things, group things, either according to Excel or QuickBooks. So at the top, we have revenue. What did we sell? So most of us are farming for profit. I know there are a few nonprofit, but what is our primary business? Whether it's selling vegetables, chickens, eggs, honey, it may be selling an experience. Somebody was talking about having a garden, community garden for school-aged people, kids. And that's your primary business. You're not in the business of getting grants, though grants are nice. You're not in the business of taking on loans and paying debt, though sometimes we need to. It's like, this is, what is your business? Your business is selling your goods and services. Then you have your cost of goods sold, COGS. And this is, I always kind of trip up a little bit on the cost of goods sold, because coming from the restaurant world, I think about cost of goods sold as, things very specifically that you have for resale. So, in the restaurant world, your cost of goods sold are the food ingredients that you purchase to then resell. For a farm business, it's a little bit squishier. It's like, okay, well, the tomato seeds are going to generate tomatoes and I'm going to sell those. So that's cost of goods sold. but what about the soil amendments or the seed trays that you start the tomatoes in? It's like, is that cost of goods sold or is that an operating expense? So the line between operating expenses and cost of goods sold is a little bit squishy in farming. So I tend to keep cost of goods sold as things that I purchase for resale. So if you have a farm store and you sell somebody else's products or you sell t-shirts, those are things that you purchase for resale. Some people do put their cost of production into their cost of goods sold, but you could also put them down here in your operating expenses. Barbara, that hand raising was fantastic. I love it. It came across my screen. I saw it. Barbara, what's your question?
So my my only concern is, so one of the things that because I've been reading a lot of books, and so has Dewey. You know, we're at 2 different locations today. That's why we're on here separately. But if you are recording your labor and your amendments separate than the enterprise, so like if you're a vegetable farmer, then you know tomatoes is an enterprise, cucumbers is an enterprise, carrots is an enterprise. You know, how do you know where you're making your money? I mean, should you be growing carrots?
Yeah,
You know?
and we'll talk about this in week 3, I guess,
Okay.
when we do enterprise analysis. But you know, there are going to be things that you can specifically assign to an enterprise. So for example, if you buy carrot seeds, that's definitely for carrot production. If you buy soil amendments, it's like, well, you know, it's like, how do I say how much of that, you know, was for the carrots versus the tomatoes versus the cucumbers? It's a production cost, but it's really hard to assign it to one enterprise. So we're going to have to come up with a mechanism to allocate the general operating expenses to the different enterprises. You know, water for your irrigation, holy cow, you know, how do you allocate that, right? So there's going to be general production expenses, and then there's going to be direct. So if you're using classes, you'll want to sort of think about categorizing it that way. But that speaks exactly to the point of, you know, cost of goods sold and operating expenses. How do you sort of delineate what is a direct versus indirect expense? So, you know, in QuickBooks, there's a section for cost of goods sold, and that's going to come above gross profit. And remember, we talked about profit earlier and how it's used in different places. Gross profit is revenue minus cost of goods sold. And in the traditional sense, gross profit tells you what do you have left over for overhead. Depending on how you categorize your QuickBooks, gross profit may or may not be a meaningful number. We may need to sort of redo the calculation outside of QuickBooks. And then in terms of our operating expenses, I like to group them into 6 broad categories. Direct operating. So does it help me grow a tomato or a carrot or a cucumber or raise a chicken? You know, it's like soil amendments help me grow the stakes for the tomatoes and the twine to stake them. You know, the soil, the seed starting trays, etc. These are directly related to our production. Then we have labor. You know, what is the cost of having employees on the farm? Certainly, you know, there's operating labor and there may be admin labor, but for a lot of farms, trying to distinguish between the kinds of labor is really difficult. So I just kind of group labor together. Occupancy, what does it cost to be on the land? Property taxes, utilities, rent. General and administrative, it doesn't help you grow a tomato, but it helps you run a business. So, you know, you need office supplies, you need internet, you need a website. Does it help you grow a tomato? No, but do you need it to run your business? Absolutely. We have repairs and maintenance, which could be argued as part of direct operating expenses, but I like to group it separately because it can be such a significant portion of your expenses. I think it's worth calling it out separately. And then one-time expenses, you know, things like fencing that you don't do every year, that fencing is part of, you know, repairs and maintenance or direct operating, but one of the things that we will do, and we'll talk about this next time when we talk about reading financial statements, is that we want to look at trends, and we want to say, my operating expenses are generally 18% of revenue. And how am I doing this year compared to last year? And if you have a one-time expense, like, putting up fencing because you just put in a chicken operation, then one year your direct operating is going to look like crazy out of line. And then the next year it's going to look good. So how do you kind of smooth out those trends? We can put the one-time expenses in a separate category. Jenny, I see your question. I'm just going to finish this up and then I'll get back to your question. And then we have our operating income, which is revenue minus cost of goods sold minus our operating expenses. And then we have the proverbial line. You have sort of below the line and above the line. So below the line are things that we need to have on our income statement because our accountant says we need to claim them as income or expenses, but they're ancillary to our operation, whether it's grants, interest expense, perhaps, maybe we're renting out a part of our barn to another farmer and we have income coming in from that. It's not our primary operation, but it is reportable on our income statement. And again, going back to reading our financial statements, when we look at all of these numbers on an income statement, we want to look at these numbers relative to revenue. And if we have all these things sort of gumming up our revenue section, then our percentages are going to look wonky. So that's why I kind of put these things down here. I also put depreciation down here because, well, I'll get to that in a minute, but hold that thought. And then finally, we have our net income, which is operating income plus or minus all other income and expenses. And that is our bottom line. So Jenny asks, LED grow lights used for tomatoes, but also for many other things. Yeah, exactly. LED lights, we can't specify them to a specific enterprise, but they are definitely part of the operations. So, we just have general operating expenses, not necessarily attributable. And we will discuss how to deal with that in our analysis in week 3. So by organizing our income statement in this way, we can see number 1, is our core operation profitable? And number 2, can we afford our debt and capital improvements? So one of the reasons why I put depreciation down here is depreciation is a reflection of all the assets that we've purchased. So, if depreciation is putting us in a net loss situation, then perhaps we've bought equipment that we really can't afford. Maybe we need to have a higher level of revenue to afford that level of depreciation. If our interest expense is putting us in a net loss situation, then maybe we've taken out more loans than we can afford. And if our grants are putting us in a net profit situation, then maybe if our business is being supported by grants, then we need to reconsider our business model. So we can see, number 1 is our core operation profitable, and number 2, can we afford our debt and capital improvements, or is something else driving our profit and our losses? And, this goes back to that question about the dairy farmer who was giggling about all the loans that they were taking out. My question is, how is their financial statement organized? And can they really see, is their core operation profitable? Can they afford their debt and their capital improvements, and what is driving this need to take out more loans? So, and obviously I don't know the answer to that question because I don't know this farmer and I haven't seen their numbers, but, can they answer that question? Do they know? It doesn't matter, one way or another, but can they answer those questions about their business so that they can figure out what they need to do to be profitable? So as we think about our chart of accounts, there's sort of what I'm calling the old thinking, that we'll group together our insurance in one category. And we have liability insurance, workers' comp, if you have employees, vehicle insurance, and your supplies, there's office supplies, there's farm supplies, there's selling supplies for farmers markets. And what I would encourage you to do is sort of rethink your categories based on how they're utilized in the farm and what their drivers are. So production costs, you produce more, they go up. You know, if you have more land, your payroll is going to go up or down. Your workers' comp is going to be relative to salaries and wages. It's not relative to revenue. And then your office supplies are sort of, you know, outside of the operation, and, you know, you're going to control them differently than you might control your production costs. So I would, you know, think about how they're utilized on the business so that you can analyze them appropriately. So for those of you who are using QuickBooks, and I know many of you already are, and many of you are thinking about it, the account type, when you're setting up your chart of accounts in QuickBooks, the account type is going to determine its position on your income statement. So, you know, we sort of talked about, you know, organizing to extract meaning and where things show up on our income statement. And if we change the account type, we change where it shows up. So anything with an account type of income is going to be in this top line revenue section. Anything with an account type of COGS is going to go after revenue and before gross profit. So you can call it whatever you want. You can call it seeds, you can call it labor, you can call it selling supplies, you could call it insurance. It doesn't matter what you call it, but if you give it the account type of COGS, it's going to go in this section up here. And that will kind of give you that option to see revenue minus cost of goods sold, which is your gross profit. And that's a number that you're going to see in your QuickBooks. All right, so Becky's having a difficult time formulating this question. So I'm going to finish this section, then I'm going to take a break and get to Becky's question. Where are you, Becky? Oh, there you are. Thank you for waving. If the account type is expenses, then it's going to go in this section. And if the account type is other income or other expenses, then it's going to go down here. So if you're sort of rethinking your chart of accounts and you have grants as income, you can change the account type to other income, and it's going to move it down here. You don't have to do anything else. You change the account type, and it's going to shift where it shows up in your reports. Any questions about that? And then I'll get to Becky's question. So Becky intends to operate like a teaching farm for children. You were recently contacted by a preschool who wants to set you up at teaching garden. Do I consider this as part of my farm? Oh, wait. Oh, my goodness, Becky, I'm sorry. This was a question that you asked 45 minutes ago. Never mind. I think we already talked about that one. I think I was scrolling through the chat window, wanting to make sure I didn't miss anything, and I got to your question again. Do you have another question, Becky? As long as I stopped.
Not really. I mean,
no pressure. You don't have to ask a question. I just,
I'm still in the stage of not knowing what I don't know.
Right.
So it's hard to ask a question because I don't know what to ask quite yet.
Yeah.
So I'm taking it in.
Yep. And, and this is, I liken this to like sort of we're building the scaffolding that, we need to sort of build the structure and the framework. And then as new ideas come along, we can sort of latch it on to the scaffolding. And, as you go to, it may make sense right now. And then as you go to apply it, it's like, oh, wait, I don't understand anymore. So come to office hours if you want more support. Any other questions? How are folks doing? Good? Okay, great. So these are some sample account names that you might have under direct operating expenses. Oops. God, sorry, going the wrong way. So you might have direct operating, and this would be in QuickBooks would be the parent category. And then the children category would be, seeds and seedlings, soil amendments, greenhouse supplies, field supplies, packaging. Some examples of labor accounts that you might have, salaries and wages, payroll taxes, disability insurance, employee meals, staff housing. What is the cost of having employees, people working on your farm? General and administrative, maybe liability insurance, professional fees, website, telephone expense, office supplies. So those are just sort of some of the account names that you might have. So the last thing I wanted to talk about, we sort of have a structure of QuickBooks that we want to think about in terms of organizing our categories, but things are going to start to get a little bit more nuanced. So I wanted to go over some key concepts. And, the key concept number one is expenses and assets. And I know we talked about this early on, like, do you categorize the greenhouse as an expense or do you categorize it as an asset? And as a general rule, things that cost less than $1,000 or so and last less than a year are going to be expenses. So things like, harvesting snips, they cost $70, less than $1,000. Yeah, this should be an and, not an or. I am so sorry. That is terrible. If it's less than $1,000 and lasts less than 1 year. So harvesting snips that maybe cost $75, they're going to last you 5 years, but do you really want to depreciate them? No, you're just going to sort of like new tools and supplies that I get every year. Things that last more than a year and cost more than $1,000 would be a balance sheet. So greenhouse, $12,000 lasts more than a year, absolutely would be an asset on the balance sheet. And things that are assets, you reflect their value over time by depreciating them. So, you buy a tractor, you have the cash outflow in year one, but then you sort of spread out the expense of having the tractor, the value that it is giving to the farm, that it is allowing you to work your fields. You sort of show that impact through depreciation. Life extending improvements are also depreciated. So if you put a new engine in your tractor, that's not just general repairs and maintenance, that you've now given your tractor another 5 years. So Lacey asks, and I apologize, I don't know if Lacey asked versus Barbara raising her hand, but so how does livestock fit across this? So meat birds versus layers and purchasing costs. So breeding stock is generally considered an asset because it's going to give long-term value to the farm. If you have, they still need to be depreciated though. So if you have an asset, it doesn't just sort of say, oh, you put it on the balance sheet, we're done with it. You put it on the balance sheet and then you have to depreciate it. So you have to you're spreading out the cost over time. So things like meat birds, I would probably just make that as an expense, livestock purchases. Layers, I would probably honestly do the same because trying to, depreciate them and then you have a 2-year life and then they get converted, processed. I don't know the gentle way to say that, but you're constantly sort of replenishing your laying stock. So I would probably just categorize that as an expense. Things like breeding stock, I might consider that an asset. And for cattle, which lasts 2 years before it's processed, I might consider that an asset, but then we need to expense it when the cattle is sent to be processing and is then sold. And hopefully that answered your question, Lacey.
Go ahead and come off mute. So that was actually incredibly helpful. When I would
look at your question.
No, that was incredibly helpful. But like breeding stock for goats, how would you then calculate depreciation for that versus a layer hen? If you're only going to have a layer hen for 2 to 3 years, and then it would then become a meat bird. How do you calculate depreciation across categories of livestock?
So there are depreciation tables that you can talk to your tax accountant about. But then, when the laying birds are converted, you need to take them off your balance sheet and expense them. And that would be done through a journal entry. You'd say, all right, I had, $10,000 worth of, oh God, that's a lot of laying birds. I have $1,000 worth of laying birds.
10,000 laying birds, that's just a different category.
Yeah, no, I know. I said $10,000. I'm like, wow, that's, sorry. Let me, you have, so first of all, laying birds are, you buy them for a couple of dollars a piece. You obviously feed them, and the feed is sort of the operating expense that enables the eggs to be produced. So, I'm sort of talking myself out of thinking the laying birds are going to be an asset because they aren't more than $1,000. And, you're just going to have to, journal entry them off of the balance sheet and expense them when you convert them into meat birds. And then let me get to Barbara's question. She's been very patient. And then Jenny, I'll get to you.
Okay, I have laying hens and we're buying meat birds this summer too, so it was relevant.
Oh, good.
But what I was wondering though is, so we did put in fencing. So, and we got a grant for some of it, and then we had to pay out of pocket for some of it. But it was like $35,000, worth of waters and fencing. It was an exclusionary project, so we got a grant from Thomas Jefferson Soil and Water because there's somebody else grazing cows on our property when we first bought it, and we'll see how long he stays. But anyway, we got exclusionary fencing to keep them out of the waterways. But with that, so that fencing then would be considered an asset, I'm assuming, from this conversation. And you don't have any idea how long fencing is supposed to last. I mean, that's something that'd be like 20 years, right?
Yeah. So, and, me and my accounting friends get into heated conversations over bourbon about this, but, there's sort of there's the depreciation tables that the IRS accepts, and then there's the market value. So, how long, can you really sell the fencing? Does it have value? But I see depreciation, and I think my next slide, where is it? Okay, I'm skipping over slides, but depreciation is a way of sort of acknowledging the value that the assets give you over time. So if you buy a piece of equipment or fencing for $25,000, you anticipate it has a 5-year life, and at the end of 5 years, it has no value. So we depreciate it every year, $5,000. It's given us, that tractor is giving $5,000 of value to our business. It allows us to operate. So it's not just like, oh, it's a tax deduction to depreciate it. It's like, actually, it's kind of a wash. I find this conversation about, oh, depreciation is a tax deduction, but it's like, do you take the $25,000 on day one, or do you take the $25,000 over 5 years? So this whole depreciation conversation as a tax mechanism is, to me, is kind of a joke. So, you sort of say, I'm going to take $5,000 of expense. That expense, it's giving value to the farm. So year one, you take $5,000 depreciation. Year two, you take $5,000 depreciation. At the end of 2 years, you've got $10,000 of accumulated depreciation. In year three, you take another $5,000 of depreciation expense. You've now accumulated $15,000 of depreciation, and so on. So it's sort of, how much value is it giving to the farm? And another way to think about it is replacement cost. You bought that tractor for $25,000. You're going to need to replace it at some point. And as it loses its value, you need to start thinking, oh, I might need to replace it. Let me set aside $5,000. That's obviously aspirational,
right?
Setting aside that kind of money, but it's something to sort of keep in mind. So Jenny asked about fruit trees that cost less than $1,000 but last longer. So fruit trees, an individual fruit tree maybe costs a couple $100, but if you're planting an orchard, the accumulative effect of it, it might be $10,000 worth of trees that you might depreciate over time. And if you have losses, whether it's a tree dying or a cattle dying, you have to journal entry. And Jenny asked a follow-up question, what does journaling them off mean? Journaling them is a mechanism within QuickBooks where you say, I'm taking it off of the balance sheet and I'm putting it onto the expense. It's quote unquote expired. So a journal entry says, going back to the balance sheet equation, what you do to one side, you have to do to the other. So if you take it off the balance sheet, you got to put it somewhere. So if you, let's see if I can find that. Oh, here we go. Here's a balance sheet equation. So if you sort of decrease a tractor by $5,000, then you're going to have an expense of $5,000 because that's the other side of it. If a fruit tree dies and you decrease your orchard value by $5,000, you now have a $5,000 expense. Now, what do you want to categorize the expense as? Do you want to categorize it as an operating expense? Or it may make sense for you to have mortality. I think about, I work with a livestock farmer, and, we have a category for mortality. It's like, I had the expense, I bought this pig, it didn't make it. It's, it's not just a general operating expense. And as I think about my business and evaluate it, how much am I losing to mortality versus how much am I spending on feed or processing or other expenses? So that can be a really helpful data point, is mortality or shrink is another term that people use. So I feel like there's been some great questions going on, and I'm sort of trying to get to everybody, and I may be cutting some short, but are there some lingering questions around this conversation about assets and expenses? Folks are good? Okay. So if you wanted to play a game, is this an asset or an expense? So you purchase 100 harvest bins for $900. Is that an asset or an expense? Expense says Jenny. Expense says Barbara. Yes, less than $1,000. You get a new engine for your tractor. Is that an expense or an asset? Asset, asset, asset. Ooh. Yes, it is a life extending improvement. It's going to help your tractor last a while. You purchase harvest snips and shovels for $300. Expense, expense, expense. Yes. You put new plastic on your greenhouse. Asset, asset, question mark, asset, question mark.
Yeah, I have a question on that, because is it less than $1,000? I mean, or is it, even though it would probably extend it 3 to 6 years?
Yeah. Yeah. I mean, and that's one of those things that can be a gray area. Depending on who you ask, it's like, this is, regular operating expense. I do it every couple of years. Some people, depending on the plastic or the greenhouse, it may be a once every 5-year project. And if you do make it an asset, then you do still need to depreciate it. So I think to that end, there's no hard and fast rules, and this is as much art as it is science in sort of deciding. And like I said, I was working with this farmer who expensed everything, but then his accountant showed me their depreciation table, and the accountant depreciated everything, or put everything as an asset. So it's all sort of smoke and mirrors, and discretionary decisions. But ultimately, you need to understand what you're doing and why, so that when you look at your numbers, you can make an informed decision about what you need to do to adjust. Barbara?
Yeah, I had a buddy who was an accountant, and he said the tell of a good accountant is when when the CEO asks you, how is this going on the books? And he's, is this going to cost us or something like that? And he says, well, what do you want it to say?
Right. Yeah, exactly. What do you want? What story are you trying to tell? So, we already talked about depreciation is an expense that acknowledges the use of assets on your income statement, and it spreads out the expense of that purchase over time. So you have cash flow on day one, but then you expense it over a period of time. And whether you depreciate it or not, you're still, going to expense it and reduce your tax burden. It's just, when do you do that? So we already talked about that. We talked about that. So the second concept I wanted to talk about is cash accounting versus accrual accounting. And who here is familiar with that? And who here is brave enough to say what that is in English? Jenny is like, not a friggin' chance I'm going to say that. Dewey.
Put it on the books now, put it on the books later.
Okay.
So cash is basically I'm accounting for it when I receive the cash. Accrual is I'm accounting for it when the deal is made.
Yep.
The cash may come in later.
Exactly.
And you prefer you prefer accrual, and I'm currently using cash in my books.
And how do you know I prefer accrual?
Well, I'm reading your book, so you said it in there. I mean,
lots of reading.
Good answer. Well played.
Your book is one of the ones that when I was trying to figure out QuickBooks at the beginning of last year, your book came up, so I got it. Really, the QuickBooks chapters were the only ones I read initially. Now I'm working on the rest of them.
Awesome. Well, thank you. I'm glad you're reading it. That's awesome. So cash accounting it's not just the revenue, it's also the expenses. It's like, was the cash received or spent? So in terms of revenue, you sold the product, you may not receive the cash instantly. So do you record the revenue when you receive it or not? Likewise, with the expenses, you may not pay for it instantly. If you have credit with your vendors, they may say, pay me in 30 days. Accrual accounting is recording revenue when it is earned. So when the deal is done, as Dewey said, as opposed to when the cash was received. And oh my God, this is the second time today my landline has rung. I'm like, what is this sound? Like, it's always so startling when the landline rings. And also when the expenses are incurred. And the goal with accrual accounting is to match the expenses with the revenue in the same accounting period. Because, if you're only recording the revenue when it's received, not when it's earned, if you have a CSA and you get prepayments, in 2021 for 2022, and then in 2022, you have all the expenses associated with the CSA, how do you know how profitable you are? Because the expenses are in this period and your revenue is in that period, and it's hard to sort of line them up. So, here's an example of an orchard that I worked with. In April, you're going to start pruning the trees. You'll have some orchard maintenance. And then in 2021, you start harvesting your apples. Or in September 2021, you start harvesting and selling the apples. But those apples you might sell straight through until March 2022. So how do you, account for it? So in 2021, you might have, 24,000 in sales from 2020. You might have $42,000 worth of sales from 2021's crops. And then some of your 2021 crops might be sold in 2022. So there you have the cash received over in 2022. You have your orchard maintenance of $20,000, in 2021 and 2022. So if you're doing accrual accounting of your income, then you've got, these are the crop sales that I made in so you have the 60,000 in crop sales in 2021, because that's what you produced in 2021, even if that's not when you earned it. So you've got, your 60,000 minus your 20,000 worth of expenses, and you've got your net operating income of $40,000. If we're using cash, then it's like, well, I got the 24,000 from the previous year, then I've got the 42,000 from this year. So I'm going to show operating income of $46,000. So if you're comparing like my expenses to revenue, it's like, well, I had $20,000 worth of expenses, which were associated with $60,000 worth of revenue, those $20,000 worth of expenses weren't associated to that revenue. It was associated to that revenue. So how do you analyze how your business is doing if you're sort of mismatching the revenue and the expenses? So that's one example. And there are various different workarounds for this. Actually, I thought that what this farmer did, which was, I thought, quite a simple and elegant solution, was that he shifted his accounting cycle. So, oftentimes we think about an accounting cycle as January to December, the calendar year. That's going to be the accounting cycle. He set his accounting cycle from according to his crops and according to the orchard. And, he set it from April until March. So his accounting year starts April 1 and ends March 31st, because all of the expenses and revenue associated with his production cycle happened in that time frame. So rather than being constricted by the calendar year, he created a fiscal year that made sense for him and his business. Here's another example of accrual and cash accounting. So Ashley says the federal government doesn't even run January to December. Yeah. And, school districts and nonprofits often run September to August. That's their fiscal year. So they, work on a year that works for them. Certainly for taxes, you're going to file January to December. You're going to file taxes on a cash basis. But you can, it's just a matter of, in QuickBooks at least, it's just a radio button that you click, am I running this report on a cash basis or an accrual basis? And you can adjust how your reports are generated for the purposes of taxes, which may be different than for the purposes of managerial accounting. So great point, Ashley, thank you. So Barbara says no. What do you say no to?
The slide.
Oh, got it. Sorry. I was like,
Sorry.
That's okay. I'm like, oh gosh, what? No. So example number 2, you're invoicing. So you sell product wholesale and you deliver $1,000 worth of product. You create an invoice for the client in QuickBooks, and you expect the client to pay in 30 days. A week later, you're going to run reports to see how things going. You are running the report on a cash basis. Will that $1,000 be included in revenue? And Barbara says no. Who else agrees with Barbara? Dewey agrees with Barbara. I know that much. And this is, and pardon my language, I know that there's at least one baby, so maybe cover their ears. But this is like a total mind fuck. You run your profit and loss and you're sort of like looking at your wholesale and that you made that sale, you created the invoice. But if you're running the report on a cash basis, that $1,000 is not included here in revenue. So, for that reason alone, I think it's really helpful to run reports on an accrual basis, because intuitively, that's actually how we think. And people think that cash is easier and they don't want to make the accrual adjustments, which, we're not going to talk about that in this session, but, it's like, how do you account for inventory, things that aren't sold, or, if you have CSA prepayments, there are all these accrual adjustments that you can make. But in your mind, like when you run an income statement, you're like, oh, well, I had that revenue, or, I sold all those CSA shares, but those are from next year. And so in your mind, you're backing the numbers in and out based on the reality, whether or not they're reflected in QuickBooks or in your reporting system. Whether you have the cash, whether you earned it or not. So intuitively, we think in accrual. So I do suggest that you set up your QuickBooks in accrual, even if you don't make the accrual adjustments, because if you sell wholesale, you want to see that revenue here in your reports. But also keep that in mind that even if you don't make those accrual adjustments, for example, CSA sales and prepayments, or if you have Apple inventory that carries over into the next year, you want to make those adjustments as you analyze your numbers. So in summary, cash accounting is better for tracking and understanding cash flow. Accrual accounting is better for understanding production and work cycles and profitability. You want to know, when did you make the sale? Because as you're making your crop plan for next year, you want to know not when did I get the cash for those sales, but when did I have 20 cases of arugula that I was able to sell. I created an invoice in May for arugula sales, even if I didn't get paid until June. And that's, you can sort of see your production cycle there, and it can help you think about, labor and planning in that regard. So as I said, set up your QuickBooks for accrual accounting. You can always run a report on a cash basis if you're interested. So what does this all mean? Accrual accounting definitely takes more work, but it's going to give you a better picture of profitability. Regardless, know which accounting method you're using and why, and be deliberate, so that if you need to make those mental adjustments, or outside of QuickBooks, you want to make an adjustment, so that when you're reading your reports to evaluate how you're doing, you want to take these differences into account. So the last thing I would just want to talk about is, daily-ish tasks for bookkeeping. And I say daily-ish because it really depends on the volume of your business. If you've got 1,000 transactions a week, you want to be doing your bookkeeping every day. If you have 10 transactions a week, once a week is probably enough. I don't think you need to be, you don't necessarily need to be bookkeeping every single day, every few days. Waiting till the end of the month, you're going to be overwhelmed and you're going to say, fuck this shit, I'm going to do it at the end of the year. And at the end of the year, you're going to be like, holy cow. And you're going to be like, I'm never doing that again. And then you're going to do it again. So if you can get into the habit of being consistent in your bookkeeping, it's going to be a lot easier. And I apologize if you all want to send me, if you're offended by my cursing, please let me know. I'm sorry, I curse a lot. And I will try to be better behaved next time. And Isaac, I see you are the one with small people in the background, so I'm really sorry. But, the more regularly you do your bookkeeping, the easier it's going to be. And little things like when you're in QuickBooks, hitting the tab key to go between fields is just like, you get those little shortcuts when you do it on a regular basis. You get, you get that muscle memory. And if you do it once a month, you forget and you're going to get frustrated. And it's like, oh, how did I enter in these expenses? Did I enter it as field supplies? Did I enter it in as, farm supplies? How did I do it? And you're going to forget, and it's just going to be frustrating. So on a regular basis, you want to record your expenses. You want to log your invoices to your customers. You want to note what invoices have been paid, record your sales and revenue and other deposits. So, every couple of days, you want to keep on top of your bookkeeping. So thank you all. I'm glad that you all speak fluent profanity as well. And I don't want to embarrass anybody. So if you are uncomfortable, feel free to message me privately. But I'm glad that nobody's offended so far. So thank you. Yes, so that is sort of the regular tasks. So that is all I have for today. Next week, or in 2 weeks rather, I'm sorry. In 2 weeks, we're going to talk about the financial statements, the income statement, the balance sheet, and how they can better help you manage your farm business. I do have office hours scheduled for next week. As a general rule, I try to shake it up and offer them in different days of the week and different times, just because I know people's schedules are all over the map. So I'm trying to hopefully get everybody at some point for office hours. So we do have a few minutes, even though this is the end of my formal presentation for today. I think folks have been great asking questions, but happy to stick around and answer more. If you feel full and sated and your brain can't handle any more today, feel free to log out, and I will see you in 2 weeks. But I'm happy to stick around and take questions or discuss. whatever's on your mind.
If I have a blank spreadsheet that I'm going to start with, because I'm like, all right, I took Julia's class and she said something is better than nothing. What are like the 5 things that I should have in that spreadsheet?
Well, I would say, first of all, you want to have cash inflows and cash outflows. And I would say, what is, if you were to sort of do 4 boxes, like cash inflow, cash outflow, and then operating and non-operating.
And if there is no cash inflow, it's just 0.
Yeah, but I mean, there will be, because if it's 0, then, there's going to be a bigger issue down the line. But, for now, and if it's all startup, that's the other thing, is to sort of keep it in mind, what's the startup expense versus an ongoing expense. So it can be discouraging to see all the cash flowing out. But know that that's not a long-term process. That's, to get you going so that you can start generating revenue, and presumably your expenses are going to sort of drop off. The other thing to think about is setting up, and I hate this word and it sounds so flippant pretentious, but thinking about your nomenclature. So is that not the most friggin' pretentious word? I don't know that I could even properly define it, but it's like the naming structure. How are you going to categorize things so that, when you categorize something as this, write a note to yourself, what does that mean? So that you're consistent in that naming structure. There's no question at the end of the year when you spent, $2,000 on X or Y, you know exactly what's in that category.
Thank you.
Yeah. Okay. So Jenny, for bookkeeping, does the farm bill change much typically? For example, if I can get my hands on an old QuickBooks CD, will it be helpful for years to come, or would it need to be updated after the next farm bill? Oh gosh, no. The farm bill does not impact your bookkeeping system. So if you can get your hands on an old QuickBooks CD, and God bless you if you can, let us know where you find it after you get your own, so don't screw up your own access. But this is one of those things that I'm just frustrated, because I know it's expensive, but it doesn't impact the farm bill. It may impact your reporting. I can't think of a scenario how it would, but I think you're in good shape. Dewey.
So 2 things. One, is there a way to get a copy of the slides? Because there was some information and I didn't screenshot as much as I normally do.
Yeah, I'm happy to talk with Amy Rose. As I mentioned early on, this file is just too big to email.